Hey everyone, and thanks for tuning in for another exciting AdvisorShares AlphaNooner. Today, we're excited to be joined by Dr. Thomas Howard, CEO and CIO of Athena Invest. Excited for a conversation today on taking a behavioral investing lens to the market and why it matters now. For everybody out there, really appreciate you joining. Again, if you have any questions, comments you want to throw in as we are going along in this conversation, you're always welcome to drop them in the chat as we go along. With all that said, really appreciate you taking the time, Dr. Howard. Thanks for joining.
Well, thanks for inviting me.
Of course. Well, so I figure it's your first time on. I think people, when they're tuning in, they want to get a sense of sort of your story, your background. Would love to kind of start there. What can you kind of tell us about, your story?
So my background is highly quantitative. I was an engineering undergraduate and then management science in my master's. And then I had finance, statistics, and economics for my PhD. So I'm a data quant. And so when I came out, it was the rise of modern portfolio theory. And what they said to me is, Tom, you don't have to worry about those messy markets. We've got all these equations and models, and they explain things. And I said, well, that's just fine with me. Mm-hmm. That's the way engineers think, But then the research just kept getting worse and worse and worse. And finally, in Black Monday, 1987, the stock market dropped 22%. We went, whoa, wait a minute. Mm-hmm. How can the markets be that rational if it goes down 22%? And at that point, I began to move towards behavioral finance. And now I'm completely steeped in behavioral finance and left modern portfolio theory well behind.
That sounds good. Well, I'd love to jump in there. I feel like most people joining might know or have some understanding of behavioral portfolio management and sort of that lens, but how could you kind of put that into easy to understand terms and, why to break away from, modern portfolio theory to go there?
So modern portfolio theory assumed away all emotions and behavioral mistakes by investors, which is really neat because then you could model it with math, and that was kind of cool. Mm-hmm. But in fact, people do make mistakes. So the behavioral portfolio management, the basic idea is you need to consider emotions at every stage. We talk about planning, advising, and investing. And so you've got to keep emotions in mind, and you've got to manage emotions at every stage. So it really is all about that.
Yeah, I think that makes sense. I mean, it feels very similar to when people think about economics. You can have sort of the theoretical economics where everyone's a rational actor. Everyone is sort of making the best decision versus, of course, what we have where, we are a system of people and people are fallible in different ways and have different behavioral quirks. So I think that's a very reasonable and rational lens to apply to investing. Can you talk a little bit about how sort of the traditional two-parameter view a little bit, median returns and looking at volatility, how does that sort of miss the bigger picture when you're kind of looking at that lens?
Well, it misses the picture because it assumes away all individual behavior and emotions. And we say, and as Dick Thaler called them, econs, we're all real rational, and that's the way we make our decisions. And again, that was the only way you could develop mathematical models to explain markets. And so you assume away everything that's interesting and important about financial markets. So yeah, I've left that behind long ago and really focusing on and looking at markets through a behavioral lens.
Okay, that makes sense. Can you give us sort of an example of how that approach might kind of find different stocks, find different areas than kind of that standard, quant or fundamental model that you were talking about earlier?
Yeah, so let me talk about our Athena Invest pure valuation portfolio. Yeah. We have three behavioral measures that we look at, and we're looking at high confidence cash flow. And how do we determine that? By looking at the behavior of market participants. The first one is management. If management declares a dividend, they're telling us that they can pay the dividend now and in the future. And the trigger on that is if they don't do it, then their stock price goes down. So it's a very, very strong signal. So that's first cash flow confidence measure. The second one is as sell-side analysts, they estimate earnings, and then we put that relative to the price, and that tells us that the analysts believe that cash flows are sufficient to justify the current price. And the third one is really the most interesting and the most emotional. We look for companies with high debt. And most people say, whoa, high debt. Well, we look at, again, creditor analyst confidence. So creditors only lend money if they think they're getting it back. And if they lend company a lot of money, they are very confident that they're going to get their money back. And they follow the stock very closely. We also have another relationship in there, as if, there's covenants in bond agreements and in loan agreements that says if you don't have sufficient cash flows, you've got to suspend your dividend. So anytime a company suspends dividend in this particular portfolio, we sell the stock right away. So those are three high confidence cash flow measures based on behavior of market participants. That particular portfolio I've been managing for over 20 years, and it has a 15% annual return over that time, about a 5% alpha relative to its benchmark. So it's a very powerful set of measures to determine which stocks to invest in.
Yeah, interesting way to what you're paying attention to and what you're weighting as important. So I think that's very interesting. I also realized I feel like I jumped in way too fast and would do a disservice to not talk about AthenaVest itself a little bit in more depth, just because I know that's a key part. I know there's the behavioral lens there, but can you also kind of high level give us a little table set on that front? Would love to hear there.
Yeah, we set this company up in 2005, and we were started out by looking at an alternative to the style grid. And Janus Capital funded us to begin with to take a look at that issue. And we came upon the idea of strategies, that the strategies managers are pursuing are the way we should classify them. And we gathered that information from prospectuses. And since 2007, we have gathered those on a monthly basis, and strategy identified all active equity managers, both U.S. and international. And that's a basis for many things that we do in Athena. We then overlaid the behavioral concepts on that, and we've then built out various tools and various portfolios based on that particular idea.
Perfectly covered. I do think it's one of those things where, nowadays everyone can kind of Google and find it on their own, but I think it makes a difference to hear directly from the person there. So I appreciate you giving that extra context. All right. Well, then would love to kind of turn, to what that means now and kind of the current market. Would love to hear sort of through that behavioral lens, what stands out for you in today's current market, today.
So we look at the market through behavioral lens all the time. In particular today, since the Fed funds rate was lowered, the target yesterday, there's a lot of motion in the markets. The markets are going up pretty strongly today. You always kind of have to worry that they overdo it. As I think I mentioned to you before we got on the air, we're in small caps. And when it was announced that the Fed funds rate was dropping by 25, our portfolios went straight up.
Sure.
And then they went straight down, and then they went back up. So it was just really a crazy day. So you've got to worry about them overreacting to this particular event. And this is probably particularly the case among the tech stocks, the so-called Mag 7 stocks. You've got to worry that the market is overreacting on those particular issues.
Yeah, that's fair. I guess not surprising to see on the small cap side things moving. We, have our own experience with micro caps, and those have definitely also moved, pretty drastically up and down. It's hard to pin down that perfect rate, what the perfect cut is. It seems like, luckily though, 25 was pretty much what was expected. 50 might have had a bigger ripple ultimately, and none obviously would have had a very negative reaction. So it seems like generally, at least in the short term, the market's reacting relatively positively, it sounds like.
Yes. Well, one other point on that is that the market anticipated almost 100% that it would be a 25 basis point drop. And yet when it happened, the small caps just went straight up, and we, Andy and I sat here at the office, whoa, what is that all about? I mean, this is not a surprise. And of course, through the day, then it did come back to earth. But those are the kind of things. And the markets are just completely dominated by the emotional crowds. And yesterday was a classic example of that.
Yeah, I think that's true. And it feels increasingly true, just sort of with the, 24/7. I know we had 24/7 coverage of a lot of, stocks and just sort of how the market's moving in the early aughts, but that seems to have only intensified, where there's so much focus on it and so much sort of ability to make headlines feel very scary one way or the other. And I'm sure that, moves people's expectations around too. So interesting there. I did want to touch on, I think positive skew is a factor that you focus on a lot. Would love to understand, why that's so important, especially in the current environment, for understanding sort of those longer term equity returns.
Yeah, so positive skew, we think of a distribution of stock returns over time as being normal, which means it has just as much positive as negative. If we look at the returns in the stock market, they're skewed to the right. There's more positive returns and bigger positive returns than there are negative returns. Mm-hmm. And that turned out to be incredibly important, because if you take the median monthly stock return over vast numbers of stocks in time, what do you suppose the median monthly stock return is? And you think, well, it has to be positive. Well, it turns out it's zero. So the median stock generates a zero return on a monthly basis. Now, if you have thought about it that way, you say, why in the world would I ever invest in stocks?
Sure.
But when you take into consideration the positive skew, and the median is just counting the numbers on both sides, if you take the positive skew, that's what generates your long-term return, and then the compounding over time. So it's been 12% equity returns in the stock market since 1980. Those are all the result of not a median return of zero, but of the skew, positive skew, and the compounding effect. Really kind of fascinating and a little bit unnerving as an investor.
I guess so. I mean, that surprised me. I would not have guessed zero. I would have guessed slightly positive too, which is, yeah. All right. Shows you, yeah, that's interesting. In terms of, so I feel like even with that in mind, how people are looking at the market right now and sort of what the kind of behavioral underlying element is, do you see a lot of kind of investors right now acting more on kind of fear, on more kind of optimism, speculation, anything that is like a key driver emotionally, do you think, in the current market?
So if I were to pick among those, I would say it's optimism and speculation. Optimism because of the drop in the Fed funds rate, that was one of the last barriers for the economy to grow faster. The next one, of course, is the tariffs. And if the Supreme Court rules against Trump on the tariffs, which I happen to believe they will, that'll be another barrier drops. So I think there's a fair amount of optimism about the economy. But there's also speculation going on, as you can see, and again, in the stock market, it's the Mag 7. I went through in the 1990s when we introduced the internet, and it was really quite interesting. Any stock that had .com at the end went straight up. And we were in the business school at that point and trying to figure out, so what is the internet and how is it? We think it's going to have a huge impact. And you sit down and you really at the beginning just could not figure out what it was going to be. But boy, you speculated. You just put .com and stock took off. It's now taken us, 20 years to figure out the internet, and it's had a huge impact. And so this is the same thing with AI. AI is just the next step of technology. And, you put AI in your name and boy, everybody just gets really excited about that. And the fact is, we don't really know what's going to work and what's not. We're starting to get some negative stories about AI and that it's not working so well in some situations. So it's like every new innovation, it takes a while. You go back to the railroads or electricity or whatever you want. It takes a while to figure out. But in the meantime, people get really excited about these new ideas. And AI is, to some justification, but it's probably more speculation at this point.
Yeah, I think still relatively early. I know you hear all the stats on how many times AI is mentioned on earnings calls or in press releases. Everyone's trying to force fit it into areas that you might not expect. In some areas that it might make sense, even though it's kind of less obvious. But in some places, it is just kind of tacking it on to try to make it seem flashy and current and modern and kind of have that AI hype attached with it. Although I do feel like, I know you're mentioning sort of things moving along in terms of technological development, but it does seem like the time for the effects to take place is getting shorter and shorter versus, the printing press to the railroad to the internet and all those things. I think there is a speeding up ultimately and kind of a desire to really quickly figure out how it's getting applied. Is it a bubble? Is it real? What's the actual impact there? So would you say it's the current kind of setup and environment you do think is most close to kind of the .com element? Anything different?
I think it's the .com situation. I mean, it's just be able to figure out which companies are going to use it and use it most effectively. Obviously, the chip manufacturers are going to, they're already taking off. But then if I do a business like ours, or a manufacturing business, or a trucking business, okay, so how am I going to use that, and can I use it effectively? And that takes a while.
Yeah, that's fair. Do you currently use any AI in your day-to-day? Curious.
Well, it's interesting. I use ChatGPT, and I use it as my copy editor. But if I'm writing an article, which I'm writing now, I write articles regularly. I've found that I cannot trust AI to write the original article.
Yes.
I tried that once, and it just came out not good. And so my research isn't completely original, but much of it is in that vein. And AI just does not do well on that, because they look at the current environment and the current research and say, this is how you should write this article. So it really works very nicely for a copy editor. So that's, I think, one profession that probably is going to disappear to some extent. But
or shrink,
creating original works, which I do all the time, I don't think AI is going to take that over.
Yeah, I don't think it can kind of replace the perspective and kind of the opinion or the actual work and the viewpoint. Ultimately, it can help kind of reduce, like you're saying, if you're doing grammar or kind of building out a section, or, all those things, I think it can help with. But I think you do need to start with the view. I mean, maybe AI does get to a point where it can kind of try to do the thinking for you, but I don't think I think we're pretty far from that point currently.
Yeah, one other way we use it, son Andy, who builds out our platforms for it, and he's just done a great job. He codes using SQL Server, and he's found out that that the AI material can create those codes.
Yes.
Very, very well. So that's one area where we're using it anytime we need to build a new SQL Server code.
Yeah, it can do a lot of the complex stuff. I think for servicing that, it can get trickier, and that's where sometimes you do need a real person to come in. But yeah, I think it can help with a ton lately, which is great. Do you have any sort of teaser for the article that's coming out? Would love to hear for people who want to check it out later. You don't have to give it all away, of course, but anything you can share on that article?
So I actually have a couple of articles coming out. One is about what I just talked about in terms of high confidence cash flows, and how cash flow is so important for valuing stock. And I basically went through the things that I talked about earlier. The one I'm writing now is about the Fed funds rate. And I had an editor come to me and said, could you write an article about what should be the right Fed funds rate? So it's a short article, just a couple pages long, look at a little bit of history, and give some ideas on how you might want to think about it. And that will come out in early October.
Okay, very cool. That is right around the corner. I cannot believe we are racing through September, but yeah, that makes sense. All right, well, people can definitely take a look at that. Also seeing in the comments, security analysis at the front of the bookcase. Appreciate your teachings, Dr. Howard, which is great. It's a good comment. All right, well then, sort of wrapping up, looking at sort of the current market. I know we were talking tech and kind of AI. Any sectors or themes that look especially kind of mispriced right now when you're taking that behavioral lens?
So the two, and we've hit on them, but let's go into them in more detail. Again, the tech sector, and particularly the Mag 7, are still badly overvalued by any reasonable measure. And that's driven the S&P 500. If you take that sector out and you just look at the other 493 stocks, they're correctly priced, and they've earned pretty much an average return. So the Mag 7 and it's now, I think, over 20, between 20 and 30% of the market has really driven that. So that's very much an overvaluation. Again, the undervaluation is in small stocks. Small stocks have lagged for a very long time. So when I came out of the PhD program back in the late 70s, the big thing was what's called the small firm effect. And so small stocks outperform large stocks, and that was the first real anomaly against the modern portfolio theory and the efficient market hypothesis. And since then, they've not done all that well. And particularly over the last 10 years or so, they've really lagged. Mm-hmm. But we think that there's a great opportunity for them to come up. And we have behavioral indicators that give us an indication of which market we should be in. And it strongly shows small caps are in that particular realm. So the combination of our behavioral signals plus the undervaluation make them a very attractive investment now. And we're seeing that. We've invested in it now for several months, and it's done incredibly well.
Interesting. Is part of that turning point just sort of if the AI promise or kind of what the expectation or speculation around AI and tech kind of comes to be laid bare, and you kind of understand what it actually can do, what it can't do, some of the kind of money will kind of fall out of that into different areas that might have been underappreciated? Is that ultimately?
Yeah, that's part of it. The other part of it is small stocks tend to be more sensitive to interest rates than larger stocks. And with the Fed now appears to be in a Fed funds lowering mode, then that's very positive. In fact, if you look at the forecast or the expectation on the futures market of what the cuts will be, it is almost directly correlated with how the small stocks do on a particular day.
Okay, very interesting. I know one element for kind of small cap, micro cap, and sort of beyond is sort of the volatile element. Would love to kind of talk through, you're talking with advisors and trying to, help clients, whether that understand that process, the volatility and kind of the tail events that we do see over time. What's sort of the conversation there, how to frame that, how to look at that?
That's really a tough conversation. So I talked about the three things that are underlying behavioral portfolio managers. There's the planning, and then there's the advising, and then they're investing. The planning is using the bucket model. Let's put money aside for our liquidity needs. Let's put money aside for our income needs. And then everything else is growth. Mm-hmm. And that's the first step. So when you talk to your clients and they start panicking about stock market, you say, no, wait a minute. Over here, you've got all your liquidity needs met, right? You've got your income needs met. This is purely growth, and this is long-term. We're looking at whatever your investment horizon, which could be very, very long, decades long. So that's the first step. And then when it actually happens, you can learn advisors that do that, use the bucket model and pursue behavioral coaching, turn out to be very successful. We have a wide range of advisors we work with, and the most successful ones, we ask, so when the market gets crazy, do they come in? And they say, no, we've set up the bucket model. We've worked with them and said, this is our long-term investing, and we know. So for example, if you'd have stayed fully invested, let's say from 1980, which is a long time period, you would earn a 12% annual return over that period of time. And that includes the Great Recession, it includes the Black Monday in 1987, it includes the drop because of COVID. It has all those really ugly things, and yet you ended up earning a 12% return. So the average max drawdown in a year is 14%. Yet the average return in the long run. So you try to talk to them about those things, and there's the advisors that are good at this really have a way of explaining it. And again, the most important thing is this is your growth portfolio. It doesn't have to perform well in the short term. It's what we're looking at is the long term, and let's stay with it.
Yeah, I think that's fantastic. I think definitely having that long-term plan and that relationship, I think, can make a difference when you're experiencing those tougher times. I know we've had even a few shocks lately. Obviously, looking at COVID was one, but even with the tariffs earlier this year, I think that was a really extreme downturn, obviously followed by pretty swift return up. Yes. But I think if you had made the error of panicking, not having that plan, leaning into the negative emotion element of it, could have been very easy to sell, get yourself in a tougher position, and not ride that back up as well. So. Definitely think that that's important to be able to have that plan, have that clear presentation, and kind of that relationship that brings people comfort to weather those tougher times over time. And then I guess in terms of talking with clients are kind of getting it understood that even though there can be volatility, it is sometimes important to take on some volatility, because I think if you're capping some of that volatility, even if it's in a small cap way, what have you, you are potentially also capping kind of your longer term returns. Is there a sense of that for people? Because I think it can be easy for people to say, I can handle volatility, it's fine. And then when it actually happens, not so much, or people who are too scared from kind of the built on trauma of the recession, all these different things, to say, oh, I'm not going to take on any risk.
Yeah, we don't think of volatility as risk. We think of volatility as emotion. And so if we can kind of change the nomenclature and say, really, when it's volatile, it's emotion. Risk is making decisions that hurt your long-term wealth. And for example, the risk managed portfolios we see, and they're very popular, cut the return in half. So it goes from 12% to 6% in most cases. So yeah, you've eliminated, but again, what you've done is you've eliminated not only the downside, but that upside, that skew, which is so important for generating returns. So that's a really soothing. The other thing is volatility is really, in many cases, the investor's friend. So for our stock picking portfolio, it turns out the wider the dispersion of returns across stocks, the better chance we have of outperforming. And so we actually have a measure of that, which we call equity opportunity. And if that's high, if the dispersion is high, then that gives us the best chance of picking stocks that are going to outperform. So volatility, we think that you've got to learn how to deal with, again, that idea of behavioral portfolio management. It's the emotions you've got to deal with. And in the case of volatility and drawdowns, it's really important to be able to manage that.
Yep, definitely agree. And I do really think that in the current moment, those emotional elements, that volatility that can come from any reactions, or even from people online on social media kind of sharing their perspectives, can really kind of froth up that emotional element. So I think it is extra important, especially now versus maybe even 10, 20 years ago, to really have that, locked in and locked down. So I think that's great. All right. Well, then I feel like this has been a great conversation, just sort of, table setting, getting a sense of how you're viewing things, the importance of sort of behavioral portfolio management. But if someone's kind of tuning in, they want one takeaway about behavioral portfolio management, what would be sort of the thing that you'd want to capture for them?
One takeaway is emotions are the most important determinant of long-term wealth. And you can be the best stock picker and so forth and so on, but it's really, when you look at it, it's emotions that determine your long-term wealth. So learn how to manage and deal with emotions at every stage, in the planning, in the advising, and in the investment management. And if you do that, you'll be very wealthy over the long run.
That is perfect. All right. Well said, well captured. How can people kind of stay in tuned with AthenaInvest research and, your article, all those things, updates? We'd love people to be able to kind of get more information and follow along.
Yeah, AthenaInvest.com. We post everything there. We have what we call our behavioral advisor, which we do on a regular basis. It talks about specific behavioral issues in the markets and how you can deal with them. And then we have a whole series of articles. I've written a number of articles, and we post those on a regular basis. So AthenaInvest.com is the place to go.
That's fantastic. So I know you have that article coming up. What would you put, any article that comes to mind that you'd say, read this one first, or one that you particularly liked that people can check out first?
I wrote an article about behavioral portfolio management, and it's one of the most popular articles on the academic side. It's still very good for the individual side. That's an article that if you want a general introduction to this, that would be a great article to read.
That sounds good. All right, perfect. Anyone who's out there and wants to learn more, definitely will point you in that direction. All right, thank you so much, Dr. Howard. Really appreciate you taking the time. Really appreciate sort of the insight, especially with yesterday's rate cuts. I think very interesting to kind of process through how to kind of look at the market right now. So appreciate it. Thanks everyone for tuning in, and we hope to catch you next time. Thanks so much again.
Thanks, Mackenzie.
Before investing, carefully consider the investment objectives, risks, charges, and expenses found in the prospectus, available at AdvisorShares.com.
you.